So if you've ever tried to raise funding for a business, you'll know that most banks will tell you you need a 3-year trading history before they can even consider you for funding. So bottom line, banks don't like funding new businesses. However, with franchises, that is the one business model where even if you're starting from scratch, have no trading history, the bank will actually still give you the funding. And the main reason for that is that franchises are meant to have a lower failure rate. Not always the case, but they should be having a lower failure rate. Why? Because essentially you are buying into a system or a business system that already works, and you have the support of the franchisor behind you. Now, I know people that have owned franchises, myself included, will tend to differ with that because sometimes you don't have that experience. But let's assume you have a franchise that actually gives you the support, the business model works, the financial model works. In most cases, the banks will be more than willing to fund such a venture. So let's look at how banks actually do the funding on franchises. So in a typical franchise, you'll normally have the setup costs. So whatever the franchise is going to cost you, all franchises will have some sort of joining fee that you need to pay. And then you'll have initial working capital. Now, this is what is most often found when you are setting up a franchise. But there could be other costs as well, but these are the three main ones, right? So the typical bank funding model is the bank will typically give you bank debt of, so that's a 5-year loan, anywhere between about, say, 50% to 70%. They'll provide a loan for that. Sometimes they can even give you that funding. Sometimes they can give it unsecured in some cases, which means that the rest of the setup cost, you need to put in equity or cash. 30% to 50%, you need your own money. So let's look at an example here. Let's say you find a franchise and the setup cost is R1,000,000. Then you see that the joining fee is 100,000 Rand, and you estimate that the working capital will be an additional 75,000. Now this is for things like stock. You might need to pay the initial deposit where you're going to be located for, your premises, and you might have to pay the first month's rent up front. This probably is a bit low, but let's just assume that this is fine. Which means you have a total setup cost here of 1,175,000 Rand. So how the bank would normally fund this, they would say, okay, we'll give you of that amount a loan of, let's say, 705,000 Rand. In this example, that is 60%, which means now you need cash equity of 470,000 Rand. Now this 470,000, if you don't have the money yourself, you can bring partners in. That's what I did when I was setting up a franchise. I found 2 partners to come in and share the burden with me. So this was not our cost. Our cost was like much lower in terms of overall cost. But just for this example, you would then find an investor or investors who can maybe come in with you, and they would become equity partners or shareholders in the business. If you can't do that, maybe you have a paid off property. You could refinance that paid off property and then access the equity, even if it's your own house. I'm not saying go and do that. This is not financial advice. It's an example. But you could also access the equity over there. But you need to put equity in, because even if a bank wanted to give you all of this money up front, you would kill that business because you are now taking on too much of debt. But banks know that. That's why they will limit your funding to about 50, 60 or 70%. And then the balance you will put in as equity from your own pocket.